All right, Ben, are you ready?
I am ready, Corey.
All right. 3, 2, 1, let's jam. Hello and welcome, everyone. I'm Corey Hoffstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hoffstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
My guest this episode is Benjamin Hoff, Global Head of Commodity Strategy at SocGen. In this conversation, we explore how commodities differ fundamentally from other asset classes, the importance of cash and carry economics, the sparse information cadence that rewards technical models, and the physical realities that challenge purely quantitative approaches. We also dive into Ben's more recent work on the geometry of the futures surface, how convexity and skewness may be misunderstood, and why tools like Lévy area may help uncover nonlinear structure in the data. Whether you're deep in the weeds of term structure trading or just curious about how to systematize chaos in barrels and bushels, this is a conversation you won't want to miss. Please enjoy my conversation with Benjamin Hoff. Ben, welcome to the show. Very excited to have you here and talk all about commodities. I feel like it's pretty rare that I get a real commodity specialist on the show, much less a commodity strategy specialist. So thank you for joining me. Really looking forward to the conversation.
Same here, Corey. Thank you so much for having me on.
So I know you didn't begin your career as a commodity strategist. For the benefit of the listeners, can you start by walking us through your background and maybe take us through the accelerated story of how you got to where you are today?
Absolutely. It better be accelerated, otherwise everyone will fall asleep. But back in my more virtuous days, I actually started off as an academic. I have, for all my sins, a theoretical pure math PhD. And I kind of got into finance really through the flow of time. I guess nothing really special or particularly designed by myself. I graduated in 2006, and at the time, everyone and their dog who could basically solve a stochastic differential equation was effectively sucked into the maelstrom of Wall Street in the city. And one of those being sucked in was me. And I ended up on a rates exotics desk at the time as a desk quant and really cut my teeth on an asset class that's all about term structure. And at the time, the bank I was with had a program that basically was designed to rotate people around different asset classes. And my second, and as it turned out, final rotation was in commodities and more specifically in commodity index. So I ended up spending a bit of time on the trading side, traded the commodity index book for this bank, and then quickly found out that my true calling, or maybe more to the point, the thing that I was least bad at was probably the sort of strategy / math piece of things. And the rest is kind of history. So I've really spent the past 18 years at a variety of different banks and hedge funds, always involved with systematic commodity strategies from a variety of different angles, and have now been back at SocGen for the past 2 years where I head the commodity strategy team.
You mentioned that you started your career on the rates side before moving to commodities. You could draw a connection between those two asset classes because they both trade on a curve, but it feels like the similarities sort of end there. Can you talk a little bit about what were maybe sort of the, for lack of a better phrase, curve culture shocks that you encountered as you switched desks from the rate side to the commodity side, and maybe how you think about those differences and how those differences shape the way you think about looking at the commodity market and the pursuing of edge in commodities?
You bring up something quite important. I mean, I think they are both obviously curve asset classes where term structure and understanding the evolution of term structure is everything. That is certainly something that both commodities and rates have in common. And I think it's something that a lot of folks who don't necessarily know the commodity asset class that well sometimes gets lost on them, just because everyone thinks of a barrel of crude oil as having a particular price and that price going up and down. But most commodity traders look at the world much more in terms of where a barrel of crude oil for delivery 1 month out prices relative to a barrel of crude oil for delivery in December. So that's where you sort of see the similarity with rates, that it is about term structure. Where I would say the biggest difference really is, and I think this is interesting both from an economics perspective, but also from a quant perspective, is the fact that the brittleness, if you like, of term structure in rates has very, very different drivers to what it has in commodities. And even when you look within commodities, it's really impossible to make generalized statements that apply to a WTI crude oil curve as much as they apply to a sugar curve. So in rates, you're typically looking at what is the Fed doing, why is it doing what it's doing, what are inflation expectations, what's going on in the FX world, employment numbers, all these kind of macro factors really feature in terms of curve shape formation. When you look at commodities, you're basically living with an entirely different set of rules of gravity, if you like. The crude oil term structure is, of course, driven by inventory, by supply, by demand, by geopolitics that affect the two. I mean, I think it's obviously very timely that we're having this conversation on June 23rd against the backdrop of the destruction of the Iranian nuclear program and a potential closure of the Straits of Hormuz, which seems to be affecting the market's thinking. It's exactly that type of event that really affects how commodity term structures, specifically crude term structures, evolve and that determine the shape of those curves. So things that have absolutely nothing to do with the typical drivers of what affects rate term structure.
In our pre-call, you mentioned this idea, and sort of to play off your last answer there, that a lot of the rates curve can be explained by expectations for central bank policies, whereas in commodities, the causal link is really this cash and carry economics. And so I was hoping maybe you could unpack that statement a little bit more, talk about inventory finance, storage capacity, and how credit conditions all sort of work together to tether spot and futures and sort of keep the dog on the leash, so to speak, and why that distinction is important for understanding why that tether can snap and when it can snap.
Yeah, exactly. I mean, I think that's actually a fantastic point you're reminding me of there. So absolutely. I mean, I'm not going to wax lyrical about an asset class like rates that I know significantly less about than I know about commodities. But truly, when you look at what determines price formation along the crude oil term structure, just to use that as an example, it is really cash and carry dynamics that form, to force first order at least, the connection point between the deferred points on the term structure and the prompt points. And what I mean by that is when you think about it, well, why would a December contract in crude be tied to a July contract? Well, the reason is very much that you can buy, theoretically at least, a barrel of crude oil in July, put it in storage, finance the whole thing, and then sell it out again in December. And that basically ties, in a very mechanical way, the price of the contract in December to the price of a contract in July. And it's that arbitrage that ultimately, to first order in a normally functioning world, and I will just emphasize normally functioning, really ties the two together. So when it comes to understanding what can really snap that relationship, there's two very obvious things that go into it. If I don't have access to credit at scale, then my ability to actually spot buy crude oil today and put it in storage is just non-existent. So that's, I think, one really important thing, and something that really does affect the way these markets and their term structure price, particularly in times of financial distress. The GFC is probably one really good example of this. The other thing is there physical storage available? I mean, it's all great. You can have all the credit in the world and at least hypothetically be able to buy as many barrels as you like on credit, but unless you can store those barrels and store them in the right location, I think that's the other important ingredient here. It's just a pure theoretical exercise, and there is no real reason then, if you can't find storage, for that December barrel to in any way be tied to the July barrel. And so absent those two things, you end up in a world where the curve structure, the term structure, ultimately starts looking really quite brittle in commodity. This is real. This isn't something that just happens once in a while when the world is falling apart or in some kind of arcane corner case. This is real. I mean, you think about natural gas. Natural gas is the archetypal example of a highly seasonal commodity where basically the Northern Hemisphere winter ends typically in March, and it's basically a market where until March comes by, we keep on drawing from storage. And the fear that the market has is that we will end winter in a situation where there's not enough left in quote unquote the tank, where we just run out. And that is what's reflected in the curve. So what ends up happening is when you look at what that actually means, it means that there's a very natural dislocation that exists, particularly at the beginning of winter between the March contract and subsequent expiries, just because it could very well be the case that at the end of winter, there is nothing left to cash and carry over to the next season. So these things are real, and it's not just natural gas, right? It's corn, it's wheat, it's beans, it's anything that's on a seasonal production pattern with constant demand, which is basically the grains, the softs, gas. You can start looking at seasonality, obviously, at a different time scale in electricity as well. But these are phenomena that are deeply inherent to commodities and uniquely inherent to commodities.
One of the key differences you highlighted about the commodities market in our pre-call was this idea of basically a sparse information cadence that comes out for commodities, that there's very little fundamental news flow in commodities. And you were of the view that this made it a fertile ground for sort of more pure technical models, statistical models. I was hoping you could talk a little bit about this trade-off of the fundamental edges and the fundamental sources of news, whether it's actual reports or weather modeling or satellite crop imagery, for example. And how should systematic traders think about balancing some of these slower moving, more sparse fundamental signals versus the faster technical signals that, left to run alone, could just become sort of wild feedback loops in the market if they are untethered from the fundamentals?
Yeah, I mean, I think context here is everything. And I mean, you bring up a really good point. It's something that I think is really quite differentiating, again, for commodities versus other asset classes, in particular rates and FX, but also equities. I mean, just bear in mind, when you look at the grains, you basically have a monthly WASDE report. Then depending on the season, you might have a crop progress report that comes out weekly. And then you've got the big nothingness of winter where basically nothing is happening. So that's very, very different to pretty much every other asset class under the sun. You look at rates, I mean, there's not a week that goes by where there isn't not just one, but multiple pieces of macro news flow, which inherently have the ability to affect a fundamental repricing of the term structure. Pretty much everything affects equities, not just company-specific news, but all the macro news that you have in rates feeds into equities as well. That is markedly different to commodities. So then the question really becomes, well, what does a market like corn trade on when there's a sparseness of fundamental news flow? So absent fundamental news flow, what are you going to trade on other than technical, or at least apparently technical news flow? Now, I say apparently because obviously the USDA is not the only propagator of fundamental information in grains markets. And this sort of ties back to your point, satellite imagery, real-time weather data. These are all obviously things that are available. But the point that I think is really quite important to make here is that they're not necessarily cross-sectionally available by the same vendor using exactly the same data collection methods, published at exactly the same time across 20 plus markets. So what ends up happening is that price really ends up being the equilibrator there, right? So the way I look at the world is that a lot of this information ultimately gets factored into pricing, and pricing ultimately ends up sort of providing this in a way where it's available cross-sectionally in some kind of transformed way, this information, cross-sectionally pretty much at the same time up to slight lags in closing time. And it's that perspective where you can kind of see that complete detethering and kind of closed circuit price formation just on technicals isn't exactly what we're dealing with. What I will say is not just to completely denigrate the role of fundamentals, but I look at fundamentals a little bit more as a way of categorizing market regimes in many ways. And you're really providing the backdrop for technical signals. And that is, I think, one really good way of using the slower moving and sometimes and oftentimes actually market specific, slower moving fundamental news flow.
I want to talk about what happens when these markets become untethered, because in the last 5 years, we've lived through what we would probably consider to be two super contango episodes with WTI crude in April 2020 And then you had the nickel short squeeze in 2022. Can you talk a little bit about operationally what has to go wrong for the curve to really decouple, and maybe use these as examples from spot? And then how do you think about trading or even just surviving these moments as a commodity strategist?
Yeah, look, I mean, I think crude going negative to the tune of $37 and change in April 2020, can't remember the exact date. I mean, that is clearly not what was intended or what is typical in these markets. So what went wrong? Well, 2020, I guess, tested a lot of different financial markets to the limits. And I think one thing really worth bearing in mind when it comes to commodities is that commodities per se, commodity futures markets broadly, and there are exceptions, but broadly are not only financial markets, right? They have a physical mechanism that basically allows the futures contract to expire into something that requires the making or taking of physical delivery of some commodity. And so in that way, when I look at commodity futures markets and I contrast them with rates futures markets, bond futures markets, there's an added layer of complexity there, and as a result, an added layer of vulnerability under market stress. So when you're in this situation where basically you've got a liquidity squeeze, you have physical dislocations, and the two happen at exactly the same time, to kind of bring up the example of crude, then absolutely you can end up with some fairly unexpected side effects such as negative pricing. That should and is not the normal state of the world, but it is just something worth bearing in mind. And it comes back to what I was saying initially. Very easy in a normal world to look at a barrel of crude and the price of a barrel of crude the same way as you look at a stock price. The truth of the matter is that the underlying financial instrument really is very, very different here. And that added layer of granularity of being able to make and take physical delivery is crucial to these markets, crucial to their survival. That's why they exist. I mean, commodity futures markets do not exist for financial investors in the last analysis. Commodity futures markets exist to facilitate risk transformation for physical hedges. So when you think of a barrel of crude oil, the thing has, on a good day, an inherent volatility in the spot market somewhere on the order of 30 to 40 vols. If you're in the physical market, you're either a consumer or a producer. That's a pretty significant value at risk to be carrying on your balance sheet. So the role that commodity futures markets have is to allow the transformation of that directional risk into a time spread risk by allowing a producer to short futures against the physical barrel. And in doing so, you end up dropping the native volatility of the combination of the spot instrument and the futures instrument by an order of magnitude, pretty much. So that is why these markets exist. Financial investors, they're great to have. We love them in the marketplace, but they are not the primary economic reason why these markets are around. That's one crucial difference with financial markets.
So before we start talking about different commodity strategies, which is where we're going to spend the majority of the time in this episode, I want to pose to you maybe what is a little bit of an unfair question, but it's one that comes up a lot for long-only investors, and it comes up a lot in academic papers, which is the question of, is there a true commodity risk premium for long-only exposure? Often long-only commodity exposure is marketed as having this idea of an inflation beta. And the question is there an ex-ante risk premium in either the spot markets or the futures markets that investors can actually harvest by simply being long commodities? And I know it's probably a very nuanced answer because every commodity market is so different, but I'm curious, as someone who has studied these markets for as long as you have, where do you come down? Is there a positive expected risk premium that can be harvested just by being net long commodities?
Yeah, I mean, I think that's a really good question, Corey, and I'd probably need to sit here and scratch my head a little bit about exactly the right way to answer. But my sense is that there's a little bit of a nuance or difference between the academic and the practical. So when people look at long-only commodity exposure, typically who you're looking at are financial players who are looking to hedge something, right? What they're looking to hedge is unexpected inflation. And so in the context of your optimization function being to hedge unexpected inflation, it definitely seems the case that commodities have sort of lived up to expectation, and at least for the past couple of decades. And provided that unexpected inflation hedge in the context of a long-only commodity allocation. Now, drilling down a little bit more, I would be very much picking up on your point that it really depends on the commodity market in question. Being monolithically long at all times across all 25 liquid BCOM or GSCI markets for the purpose of pure alpha generation, I mean, the backtest basically tells the story. There is no alpha there. In fact, there's probably negative alpha there. So you would probably need to be a little bit more nuanced if you were looking at the world in terms of alpha generation. And indeed, there's an entire industry around this, which I'm sure we'll come to talk about shortly.
In your article, Commodity Factor Investing, you propose a really novel concept where you map the entire commodity term structure into this 2D surface where you have calendar time on one axis and time to expiry on the other. And using this surface, you actually recover familiar investment styles like momentum and carry as partial derivatives of this surface. And this is the first time I'd ever read something like this. I thought it was really unique. What do you think that this lens, this approach of thinking of different investment styles via derivatives of this surface, what does that reveal that maybe some single factor studies where you're looking at these things truly as isolation and not simply as derivatives of a common object? What do those single factor studies miss that this surface view provides you?
Well, probably the most important aspect for me when I look at what generates commodity alpha in general is what is the economic principle behind what we're trying to do here? And, that was very much the inspiration of this paper as well. So when I look at what is likely to persist, when you've got any alpha signal, commodities or elsewhere, it doesn't really matter. You really care about two things. One is the strength of your signal, and the other is how long is the signal likely to persist for? And you really want to have a combination of both because a strong signal basically kind of means that you're more likely to hit your target. Persistence ultimately means that you're in a world where you're not just flipping around perpetually. And so when you think about this whole idea of effectively fitting, if you like, a tangent space to the surface that's made up out of one dimension being time to expiry and the other dimension being time, you can kind of see that what we're trying to do here is really just capture the fact that hopefully that tangent space is going to be slower moving than the thing we're effectively approximating. And that's something that's quite common in mathematics. I mean, that's why people look at derivatives of curves. That's up to some order because they don't necessarily care about the super fine structure that's captured, 5 orders down the Taylor expansion. They're good enough just knowing, what is the first order and maybe the second order derivative. And so the approach here is effectively to say, look, it's the first and second order derivative that actually have meaningful economics associated to them, and they're cross derivatives. So the derivative with respect to time, the second derivative with respect to time, the derivative with respect to time to expiry, the second derivative with respect to time to expiry, which is effectively the convexity, crucial for carry strategies, and then the cross derivatives. And so that's really where we were coming from there, is to basically say, look, where is the persistency likely to be? Truth be told, this comes back to where we were a couple of minutes ago. Commodity markets ultimately are designed for physical hedges. And physical hedges, they can't afford to operate in a world where the curved surface is effectively snapping around in a completely random way every day, right? That just does not allow for rationally based hedging decisions that can persist through time, and that's ultimately what they're after. So you can kind of sort of see which came first, which came second, probably a little bit like chicken and egg, but the truth is you cannot have dynamics which are completely random when it comes to the actual curve dynamics that are captured by these derivatives.
And just for sort of completeness, to make sure everyone's on the same page as we're talking about this, can you walk through each of the derivatives and how it links to maybe what already exists in the literature as one of the style premia, or whether it represents maybe a unique factor?
Yeah, no, absolutely. So look, first of all, I'll just preface it with the fact that it's not a panacea. You cannot recover every single commodity QIS style with this approach. But the styles that you can recover, The first derivative with respect to time, is basically trend. The second derivative with respect to time, still kind of some version of trend. You can maybe call it trend of trend. Then you start moving on to derivatives with respect to time to expiry. The strategy that's been out there for a long time now is something that's often labeled as backwardation momentum, which is effectively ranking of a portfolio of commodities according to the slope of their term structure, where the idea is to go long the markets that are most backwardated, so where the front of the curve is pricing at the strongest premium relative to the back of the curve, and short the markets where you've got the exact opposite, where the front of the curve is pricing at a discount to the back of the curve. So that's something that pretty much linearly maps to the first derivative of the surface with respect to time to expiry. The second derivative with respect to time to expiry is really convexity. And convexity is a crucial driver in carry strategies. When you think about commodity carry, what's the idea? Well, the idea is to be short the front of the term structure and long the back of the term structure. Now, if you've got a perfectly linear curve, and I would say gold is a good example of this most of the time, where effectively gold basically just prices on a carry basis that's relative comparative to the value of an ounce of gold. The storage of gold is de minimis. The insurance costs are relatively small. So what you end up with is effectively this financing cost, which is just linear in the cost of gold. So gold effectively is an example of a market where being short the front of the curve and long the back of the curve could theoretically generate really nice Sharpe ratios, but almost no returns, because rolling down the front of the curve at exactly the same rate and making money because you're short, as you're losing money on the back of the curve where you're rolling down as well at exactly the same rate, but in that instance, you're long. So that's not a good example, but other markets like crude, like natural gas, you've got the situation where there's negative convexity in your term structure, where basically if the curve shape doesn't change and it stays exactly like it is today, and the only change is really the fact that time keeps marching forward, then what happens is that due to the negative convexity, you're rolling down at a slower rate in the back where you're long than you're rolling down in the front where you're short. And because you're rolling down at a higher quote unquote speed in the front, you end up making more money on the short side than you're losing on the long side. So this notion of convexity, absolutely crucial in carry, also because it's relatively slower moving. Now, it's obviously not the only driver of a carry strategy, because carry strategies obviously have sensitivity to changes in slope. But changes in slope, this basically comes to the next value style that's incorporated in this curve derivative framework, which is basis momentum, right? So basis momentum, the idea broadly behind basis momentum is to ask, how is the slope of the curve changing through time? If I've got a positive change of slope through time, I probably want to be going long because the curve is steepening. And if I've got a negative change in slope through time, I want to probably be going short because the curve shape is weakening. So again, you've got sort of the final version then of QIS strategies that are encapsulated. Now, what's interesting, Corey, is that there's clearly a limit to this, right? You could keep on playing this game of effectively having higher and higher Taylor order expansions, but I touched on this briefly in one of the previous questions where we talked about how producers and consumers can transform their flat price risk into spread risk by trading futures against their physical position. And in so doing, their advantage to them is that they end up reducing the volatility by an order of magnitude. Now, what we've just been talking about is kind of similar, right? If you wanted to, you could probably play this game of expanding your curve approximation to higher order derivatives. But the problem is, if you really want to capture the third order derivative, you need to be trading spreads of spreads, so two spreads on the same curve. And in so doing, you've effectively just dropped your volatility by another order of magnitude. And so you get to this point where it just basically ends up being a negative trade-off between the alpha you could theoretically harvest and the transaction costs that you're incurring to do so, where basically the alpha that you're trying to capture just does not have inherently enough volatility to justify that. So that's why most people, us included, would typically say, Second order is as far as any reasonable person can possibly go.
I want to go back to the point you were making about carry strategies, because carry strategies are a very commonplace in commodities, especially commodity QIS. And you wrote a paper in 2024 titled All You Ever Wanted to Know About Commodity Carry. And you highlighted in that paper this idea that traditional carry includes significant exposure to this second order term structure convexity. And it's not just sort of this linear roll yield concept. And so for people who are hearing this for the first time, right, who maybe haven't thought through the world via this surface idea, this sort of second order derivative and what that convexity means, how should allocators to commodity carry or people who are designing commodity carry strategies reinterpret classic carry metrics in light of this convexity? How should they be rethinking about what this convexity component of returns implies for what carry is ultimately pricing and the risks embedded in carry styles?
It's a really interesting one because I find the whole convexity notion actually allows you to articulate in very clear, intuitive economic words what specifically the risk premium is that you're trying to capture. When you think about commodity carry strategies, I mean, you can do a PCA of any principal component analysis of any commodity term structure, and you'll find that, well, the first three principal components are really dominant. The first one is basically just level price movements. The second one is changes in slope. And the third one is basically the convexity piece. And when you look at the first two, they basically are highly subject to exogenous shocks. The third one, the convexity piece, is actually much more about the micro supply chain of an individual market. And so just take crude oil as an example, just because it's June 23rd, it's topical. We actually have Iran potentially threatening to do something that would affect the flow of crude, at least a pretty significant chunk of it. And we can see this effect at play. So when you think about crude oil, if you're an independent refiner, you can't put a barrel of a futures contract into your refinery. What you need is a physical barrel of crude oil. And we talked about this earlier, is this whole idea of risk premium that gets reflected through the convexity, right? The fact that the front rolls down a little bit faster than the back. What you're saying in different words is that the front is pricing a little bit richer than it actually should compared to the back. And the way that quote unquote mispricing, it's not a mispricing, it's a risk premium, the way that evaporates away in a world where there's no materialization of stock out risk is that the front rolls down just a touch faster than the back, and you end up monetizing that. That is effectively how that convexity plays out. And that is something that's actually very easy to put in words, very intuitive. And when you look at it from a portfolio perspective, one of the beauties of commodity carry, and you can really see this play out over the past couple of decades, really, is how robust that strategy is. And the reason it's robust is because you've really got causal decorrelation at play there. What constitutes a stock out risk in crude oil is some geopolitical event, which we may or may not be experiencing right now with Iran threatening to close the Straits of Hormuz. What affects the realization of a stock out risk in natural gas is really an unseasonably cold winter. And so it goes. You know, the same basically holds true for grains, for softs. Anything that has a harvest ultimately is subject to weather risk. And the fact that these weather risks happen in different geographies makes them decorrelated. Moreover, all of them combined, they all are ultimately very decorrelated to what would constitute the equivalent of stock out risk in other markets, such as rates and FX. So that's why commodity carry is in many ways so robust and applicable in a broader portfolio context.
When you talked about the surface, you mentioned that not every commodity strategy necessarily fits neatly into this surface model. And two that come to mind that are popular are value and skewness. And so my first question would be, my presumption is that those don't fit nicely onto the surface. So maybe if they do, how do they map? And if not, how do you think about these exceptions in this sort of surface modeling world you've created?
You're exactly right. I mean, I think skewness and value are two popular strategies which just don't fit. Skewness is obviously predicated on capturing tails or historic tails in the return distribution of individual markets. So that's a notion that has nothing to do with a surface, so hence it doesn't fit. So in short, the answer is I don't think about them in the same way. I think about them as really something that is completely orthogonal, certainly for skewness. Value in many ways is an interesting beast because it seems to me like there's quite a proliferation in terms of what different banks call value. There's a lot of different implementations. None of them have anything really to do with the surface model. Although I would like to say one thing here, Corey, probably one unifying concept for value is that each of these curve factors can be traded on a value basis if you just view value as mean reversion to some extent. Now, the question is what is likely to mean revert? And that, I think, is really where the complexity comes in. Value in commodities is a difficult thing to really get right because as opposed to what one might think when one first hears value in commodity space, the way value is usually implemented in some QIS strategies is that it's implemented on more of a cross-sectional basis, right? And when you think about what you need to implement anything on a cross-sectional basis, you need a unified methodology. Then you sort of turn back to the commodity asset class, and there you are looking at, and we were talking about this initially, crude, which depending on the specific grade you're looking at, if you're looking at WTI, you've got weekly Department of Energy stats. If you're looking at corn, you've got monthly WASDE reports and possibly, depending on the time of something, that's crop progress reports at a weekly frequency. But what's lacking is some form of unifying framework for the signal. So what a lot of people revert to is just kind of using price as a proxy for value and then end up sort of basically saying, well, how deviant am I today for a given market from what the 5-year average price is? And that's effectively going to determine my mean reversion level. So there's obviously a million things that are not 100% correct with that particular model view of the world. One of them is the fact that 5 years is a long time in commodity markets, and you're not necessarily capturing a stationary phenomenon if your look back period is 5 years. The question is, do you have enough data? If you start shortening your look back window to something shorter. So there are a lot of potential issues with that. But the overall point here is really, what do you define as value? What's going to mean revert? And that is really the only connection that I can potentially see with these types of curved surfaces.
For the mathematically inclined, your curved surface model has a lot of appealing features, but I can imagine that if you're not incredibly thoughtful in your translation from a curved surface model to some sort of strategy implementation, you might actually miss the fact that you could end up connecting contracts that in the physical world can't actually be transformed into one another because they're truly physically different products, right? A different harvest, whatever it is, they're not truly the same thing being sold, despite the fact that those contracts arguably exist on the same futures curve. Curious how you think about guarding around that in developing strategies using this surface model concept.
I really appreciate the question because to some extent, it really highlights the specificity of the commodity asset class and the fact that when you've got a hammer, then not everything is a nail, or at least not everything is the same nail. A good example, I think, to maybe illustrate this a little bit for listeners is when you think of something as mundane as gasoline. Gasoline futures, relatively liquid, but the truth is summer gasoline is chemically not the same thing as winter gasoline. They have different Reed vapor requirements, which basically mean that summer gasoline chemically has a different constituency to winter gasoline. What you can deliver into the contract is chemically different and priced differently. So there's no reason ever, under any circumstances, to believe that winter gasoline, call it a January contract, should roll up to the same price as a July contract. They're just chemically different things. The same obviously holds true when you start looking at seasonal commodities, right? It holds a little bit less true because it really depends on the year. If you end up in a year where the winter is relatively mild, then yeah, absolutely, the March and the April contract should become potentially fungible in physical space if the stock out risk premium really just drops to zero. But absent that, there's no reason that you should have roll up. And that's something where basically part of it is just calling a spade and being able to really just recognize that you can have markets which might arrange chemically different things in the same term structure. And you can have other markets that are highly seasonal in nature where that seasonality can perturb the arrangement of contracts that look like they're smoothly connected on the Bloomberg terminal. Call a spade, and you're fine to go kind of thing.
I want to jump into a specific strategy implementation. In a recent paper you wrote where you talk about lead lag effects, both cross-sectionally and along a single curve. And you introduced this idea of what's called a Lévy area metric. And so I thought this would be a fun example to dive deep on a recent strategy concept you proposed. First, can you provide some background as to why you believe lead lag is a fertile signal to be harvested in the commodity space? And then draw this connection to what is the Lévy area signal and why do you think it is the appropriate signal for harvesting this lead lag effect?
So look, I mean, when you look at commodities as an asset class, just from a fundamental perspective, it seems relatively apparent that there should be lead lag effects, right? When you think about, take any market that's about feedstock and refined product. I mean, we can look at energy liquids, but there are others as well. Bean oil, the beans complex is another one. Bean oil, bean meal versus beans, the crush spread. But if we just focus on energy liquids, the truth is that if you're an independent refiner, you're going to have price sensitivity to your feedstock, but it's not the feedstock that you're selling refined product. And it's not crude oil that consumers consume, it's refined product. So the business model is basically the margin between the two for an independent refiner. The margin is effectively directly proportional to what you can sell your refined products for versus what your feedstock costs are. And so when your business is to optimize that spread, then you are going to be keenly focused on effectively passing on and adjusting the pass on of feedstock changes to your end users. And also the flip side obviously holds as well. When demand starts eroding, how long does that take before it shows up in terms of demand for crude oil? Typically, most refiners will have feedstock in storage, which they may choose to run down prior to bidding for new crude. So it's those types of effects which one would expect to show up in pricing in commodity markets as a whole. So this is sort of where this paper really came from, is sort of asking the question, well, over what timeframes and under what circumstances does it make sense to try to exploit these types of lead lag relationships? Now, there's obviously a whole academic body around measuring and isolating lead lag relationships. Probably the most trivial way to do this is by just looking at the autocorrelation of two return streams. And effectively, the lagged autocorrelation should effectively tell you whether there's a lead lag relationship there. The problem is, one would expect that if you reverse time, any such methodology should then also reverse who it identifies as the leader and who it identifies as a laggard. And the problem with autocorrelation is it really completely fails that. It's completely agnostic to the meeting calendar time. So in that sense, the risk with these types of measures that are autocorrelation based is that you end up picking up things where there isn't really a lead lag relationship and missing out on other things where there is a lead lag relationship just because the methodology isn't clever enough to see that. That's sort of one issue. The other issue, is another popular choice to measure lead lag relationships is Granger causality. But Granger causality makes an implicit model relationship, and the model relationship is the thing that's leading and the thing that's lagging are somehow linearly related. So when they're not linearly related, then again, you run the risk of kind of missing out on part of the information set. And this is really where Lévy area comes in. So Lévy area is basically something that's pretty deep from a mathematical perspective. And I want to sort of wax lyrical on things that are quite frankly above my academic pay grade. But Lévy area is a derivative of, or part of, a broader mathematical theory called the theory of rough paths, which allows you to basically solve stochastic differential equations path by path. So as opposed to getting an answer or solution that's a stochastic process or a random variable, what you can do is you can solve along something that's as rough as Brownian motion and effectively say, here's the deterministic answer that you get if you solve a system along the specific Brownian path. So it's pretty deep. It's got a lot of potentially interesting applications in machine learning. But the way we've used it here is that Lévy area is effectively the antisymmetric part of the second order iterated integral of a multidimensional path. Now, I've probably lost everyone, including myself, in saying this, but what it means intuitively is that if you have two asset prices and you're calculating their Lévy area, what you're doing is you're letting those asset prices run through time, stopping the clock, connecting the endpoint of that two-dimensional path that you've just run in the plane with the origin, and asking, what is the oriented area that I've traced out between this path and the chord of the path with the origin? And when the path has a propensity to orient against counterclockwise, you get a positive Lévy area. When the path has a propensity to orient clockwise, you get a negative Lévy area. And so one way to get a positive Lévy area is if the first constituent of this two-dimensional path, so the first asset, leads or largely anticipates the second asset. In that case, you get a positive Lévy area. Why? Well, I kind of go through the gory details of the math behind this in my paper, but it's not actually that complicated if you just take a simple little model path and go through the math. And the same holds the other way around. Now, the beauty of this is that it's effectively model-free. I'm not making any assumptions between asset A, the relationship between asset A and asset B. They can be linear, it could be nonlinear, it could be a polynomial, it could be a sinusoidal curve. I don't really particularly care. I'm just measuring particular path statistic here. So the other thing that's really nice about it is that it addresses one of the deficiencies of autocorrelation, which is that if you permute asset 1 and asset 2, or put differently, if you reverse time, you flip the sign of the Lévy area. So you've got these two properties which make the Lévy area quite an attractive way of measuring lead-lag relationships. Moreover, and this is something that kind of goes a little bit deeper here, you manage to pick up lead-lag relationships at different time scales simultaneously. That's also pretty powerful. So that was something that we kind of deployed in two frameworks. One was just cross-sectionally identifying across a portfolio of commodities which one is the set of leaders, which one belongs to the set of laggards, and then positioning the laggards in the direction of the leaders tomorrow, hedging them with the leaders of today. That's one system. Seems to work relatively well, robustly, particularly in energy liquids. The other system is looking at term structure, right, where you can basically play exactly the same game, but this time using different points of the term structure for the same commodity. So there too, you end up with lead-lag relationship. And what's interesting is that the lead-lag relationships that you identify in the second term structure-based approach allow you to really quantitatively make statements about how is a curve steepening? How is it weakening? Is the steepening of the term structure driven by the front of the curve, or is it driven by weakening of the back of the curve? The two mean very different things, and they're not necessarily visible to the raw eye, and certainly not visible on a statistical basis where you can run this all through some kind of clever Python script, which basically tells you statistically the copper curve is more likely to steepen led by the front than the back. So those are the sort of two major applications, really, Corey, that we came up with.
The paper shows really impressive Sharpe ratios, quote unquote, in the theoretical limit before we start to apply transaction costs. How close can real money traders get to the performance quoted in the paper once we start to layer in liquidity constraints, once we start to talk about trading the markets outside of the major liquid energy contracts? Is this the type of strategy that truly can be traded in isolation, or is this the type of strategy that should be used as a conditional trading signal when executing other strategies, more of as an input to a larger portfolio optimization?
A good reason why we put this paper out is the theoretical limit. One is because this is research and not structuring. So there's a little bit of a line between the two. But to answer your question specifically, the directional systems that we have, particularly those in energy liquids, are close to what is reasonably implementable, factoring in transaction costs. So transaction costs will impact performance, but to the point where you probably going to pay away on a strategy that has like a 1.5 Sharpe, maybe half a Sharpe, probably a little bit more, and still end up with something, provided you've got the technical setup in place that is actionable. Now, the curve strategies, the way I would look at those is there's always a trade-off here, right? You can find all kinds of alpha when you're not correcting for transaction costs, but the transaction costs, again, they are kind of very much specific to individual clients, and it's difficult to really use generalized rules as to how much someone's going to pay to trade a particular spread full circle. But the way I would probably think about building a system out of this is that I would ignore the signal if it were choosing me a spread that just has a volatility that at least statistically has been too low to justify the transaction costs associated with trading it. There are all kinds of ways then, obviously, on top of that you can use to slow this type of system down. Do you want to be looking at a look-back period for your lead lag formation that's 20 days, or do you want to be looking at 30 days or 40 days? Do you want to be looking at a directional position formation that looks at 2-day returns, 3-day returns, 5-day returns? You're going to get very different results that are going to atrophy some of the performance away, but simultaneously are going to have a positive effect in terms of reducing transaction costs. And that ultimately is really something that depends on where the individual trader is set up commercially.
Another paper you wrote called Seasonality's Greetings, great title. In that paper, your work suggested that static monthly seasonality premia are elusive, but weekly patterns, especially in highly liquid energy markets, actually persist. Curious how you reconcile those findings with sort of the very intuitive, very real seasonality fundamentals that exist in commodity markets like the ags.
Yeah, so I think that's a really good question as well, Corey. So what's interesting about commodities is that there's a little bit of a mismatch between fundamentals and what markets are pricing. So just because you have a clearly seasonal term structure, so forward curve, does not mean that there's actually money to be made of that seasonality. The market could be exactly right in the way it's pricing today, its expectation of a seasonal phenomena that's repetitive 3-4 months out. And when that's the case, that's exactly the situation where you end up effectively putting on a trade on the basis of some seasonal phenomenon, but effectively seeing no return. And to me, that's in many ways, from an economic perspective, actually quite encouraging when we see that, because of what it's telling you is that the market is actually typically quite effective at pricing seasonal weather effects correctly. Not every year, but through time, that certainly seems to be the case. And that's ultimately a good thing, not a bad thing, because when it comes to what these markets are designed for in the last analysis, I keep coming back to this, producers and consumers and facilitating their business, ultimately what you want is kind of micro-insurance that's fairly priced. And when that seasonal risk premium is compressed, then that's exactly the situation you're in, that micro-insurance has been fairly priced. So to me, that's encouraging. Now, you also mentioned the fact that seasonality can obviously occur at different time scales, right? There's obviously our shading as human beings is that we think of seasonality in terms of summer, winter, fall, and spring. But effectively, from a mathematical/trading perspective, seasonality could exist intraday. It could exist on a weekday basis. And so we kind of took a look at the weekday pieces as well. And, it's interesting. What ended up transpiring is that the group of commodities that really stuck out, and, we've got a little chart of this in our paper where you can really see TI, Brent, heating oil, gas oil, all globbing together. And from a sharp perspective as a weekly seasonality trade. And what's interesting as well, and this is kind of where I always just sort of see in many ways the limits of my own knowledge. You can look at the results and then you can find the story afterwards, or you can come up with the story and effectively find the numbers afterwards. But the truth of the matter is it's unclear that there's necessarily a causal connection between the two. But there's a case to be made where when you look at independent refiners, again, that seems to be my go-to example, from their perspective, one of the largest business risks that they have is weather. And it's also one of the largest business risks that they have on an intra-week basis. Why? Well, because effectively they run their operations 7 days a week, but they can only really hedge 5 days a week. And demand for products ends up being largely weather determined That's true both for driving and it's true for heating demand as well. And so you end up in the situation where, and this is the economic argument, I'm not saying it's necessarily the cause, but it's the economic argument for these backtest results. You end up in the situation where refiners are arguably incentivized to hedge as close as possible to the weekend when they know or have a better idea of what the weather for the weekend is going to be rather than 3 or 4 days before the weekend. So typically a refiner is per se long what we call cracks. So product cracks are long products, heating oil, RBOB, jet fuel, gas oil, and they're short feedstock being crude oil. So what they're going to do is their hedge is going to be the other way around. The hedge is basically going to sell product cracks. So effectively, by selling 1 unit of product cracks on a Thursday, buying a couple of units, 2 units on a Friday, and then selling the remaining unit on a Monday, you can kind of create this trade which provides liquidity to refiners, to independent refiners. And that is at the core what we think we're picking up here in terms of this weekly seasonality that isolates the energy liquids.
I want to take a huge step back here. We've been diving in the weeds of all these different strategy ideas, and I want to talk about commodities as a complex, and commodities as a complex over time, because there's been a dramatic financialization of commodities over the last 30 years, arguably since the GSCI index became investable. And as I'll call it passive AUM poured into the market, certain strategies worked, like congestion strategies, and then they didn't. I'm curious, through your lens as someone who's operated as a commodity strategist for almost 2 decades now, what's changed in market structure? What has become a structural change, and what are sort of cyclical changes that you see evolving through the market that maybe make some strategies more appealing at certain times than others as financialized interest in the commodity space sort of waxes and wanes?
Yeah, I mean, I think you bring up congestion. I mean, congestion strategies, pre-roll strategies are basically premised on providing liquidity to long-only commodity index investors. And so you kind of end up in this situation where the issue really becomes what happens once the index has been provided all the liquidity it could possibly need. Does the roll signature of the index start depreciating? And I think that's probably part of what we've seen over the past couple of years. Simultaneously, you're absolutely right in pointing out that if the core driver of these types of strategies is ultimately the existence of sufficient index AUM in commodity markets, then it's probably worth paying attention to the cyclicality of that index AUM. And that's undeniable. I mean, there's a bunch of folks out there, as we discussed initially, who are basically looking to hedge their unexpected inflation risk through commodity index. And as inflation fears wax and wane, so does commodity index AUM. So that should have a trickle-down effect to pre-roll strategies. Now, that's kind of one side of the ledger. The other side of it is the fact that you have a variety of market microstructure changes that have been, in many ways, the result of an increased financialization of commodities. So specifically, when you look at how people estimate commodity index AUM, it's usually premised on a relatively simple model, which assumes that the world basically consists only of 2 commodity indices, which is the BCOM and the GSCI. And then furthermore assumes that all the AUM is held in the very front of the curve. And basically by isolating the 2 markets that are unique to the GSCI and the 2 markets that are unique to the BCOM, and overlaying that with the AUM the AUM that's reported in the supplemental commodity index trader report that the CFTC publishes every Friday, you can kind of extrapolate out what is the BCOM AUM and what is the GSCI AUM. Now, it turns out that it's probably been a couple of months since I last looked at this, but in late 2024, in fact, GSCI AUM ended up apparently going negative on the basis of this model. And that was largely driven by cocoa, right? So the issue really becomes, what happens when you've got these smaller markets where people might be using the index and get reported as using the index for taking positions that have nothing to do with the broader index. Then you can kind of have these perturbative effects. And I use this as an example, not so much to go into the depths of how index AUM is estimated, but more just to show that the financialization of commodities has meant that you've got a whole swath of investors in these markets now that may not be solely commodity index long only guys. And that's changed the market structure. And this is one very specific example of how it's impacted the index world and AUM estimation.
Well, your cocoa example leads me right into my next question. You made a brief comment at the end of our pre-call about thinking about the ties between commodities and systematic macro and how systematic macro traders incorporate commodities, right? And cocoa, the trade you're talking about, I think was a trade that got heavily influenced by CTAs, right? In many cases, CTAs, trend followers in particular, think of commodities just as another, I think this is your quote actually, just another return stream to risk balance at the end of the day. Curious as your thoughts, as commodities are an active component of a lot of macro and systematic macro strategies, how do you see the macro linkages to rates and FX and equities? And how should a systematic macro trader decide when a commodity signal is really idiosyncratic to commodities versus something that's more globally allocable?
Yeah, I mean, I think that's, again, a fantastic question, Corey. The way I'd probably answer that as a first stab is it depends really on the design of the underlier that the signal is being applied to, right? I mean, you can have any number of pure macro signals that ultimately will trickle through to how a particular curve shape evolves. And if your implementation is curve shaped, then really what you've got is an interpretation of a particular macro signal on the microeconomics of a particular commodity rather than an expression of a macro view. It's a micro expression of a macro view. So to me, the investable and the investable design is quite a crucial point. The other thing is, look, I mean, truth be told, you can't really be a systematic macro trader without understanding commodity micro relatively well. And I think gold is a fantastic example of this, right? So truth be told, there's a million different ways that you can trade half of the things or 3/4 of the things that gold is sensitive to. You know, you can certainly trade de-dollarization or debasement of dollars, that theme in FX markets, way more liquidly actually than you could trade it in gold, way more specifically arguably than you could trade it in gold. You could do the same with inflation, right? Just so happens that gold is basically a catch-all for all things macro. So it ends up having sensitivity to inflation. But the truth is, if you really wanted to put on an inflation trade, you would probably not choose gold to do it, because the more specific your macro trade is, the worse an alternative gold ultimately ends up being, because you'd probably want to trade inflation in a particular currency that you have a particularly strong view on, not on something as catch-all as gold. So gold has all these things, but then it has an additional sensitivities that are not really captured by most other ways of expressing better known macro risks. And I think a lot of that is sort of what's really come to the fore over the past 6 months, notably even over this weekend. You know, what other commodity, what other market really gives you sensitivity to policy uncertainty, to weaponization of financial systems, to systemic counterparty risk, to geopolitical instability? That is what's unique to gold. So the way I look at commodities in the context of systematic macro is really, how do I strip out of commodities all those micro effects and to some extent the macro effects that can be expressed in other markets, and what am I left with? And that, I think, is really where ultimately the linkage is, and one that you really probably don't want to be ignoring.
We didn't really dive into it with your background, but you have actually worn both hats in designing transparent bank QIS products, as well as running performance fee capital at a hedge fund in the past, both in the commodity space. How does the role difference change your appetite for esoteric signals, complexity, and liquidity risk? Generally, just how does it change how you think about strategy design when you're sitting in these different roles?
I think the products are really different in their detail, and as a result, to whom they cater to. When you buy a bank QIS product, what you're looking at is a product that's basically designed to provide maximal transparency, oftentimes, certainly in commodity space, daily liquidity. When I say maximal transparency, usually you, as an investor, will end up with a very fat index handbook, which details exactly what happens in all kinds of corner cases to the index that reflects the strategy that you're implementing in swap format. So maximum transparency there. You're also typically looking at a product which has been vetted for liquidity. Truth be told, most banks, this is a business that is operationally intensive, it's legally intensive, it has to scale for the economics to add up. So no bank is necessarily interested in designing a very complicated index for a QIS strategy that can't hold significant assets. So those are all really positive, important aspects for an investor. And as do most things in life, everything that has its upsides also has its potential downsides, right? Because not every strategy is necessarily QIS capable. We were talking earlier on about lead lag trading systems. Depends on the frequency, on the turnover, on the cost structure, whether such a system in a particular parameterization is relevant to a particular bank to cast into a QIS product. And again, the answer for one bank might be different to another bank, but that just does not hold when you start looking at hedge fund strategies. When you're looking at hedge fund strategies, you aren't passing on a rulebook that might be hundreds of pages thick to a client. You ultimately do have that level of indirection, that level of discretion around the edges. You can see whether a particular strategy might be particularly relevant in a market that is just not so liquid. You can decide that just because something's been working for 2 months systematically, you might still include it, whereas most bank products ultimately will require multi-year backtests. And you do not need to necessarily provide daily liquidity on the close. There's no commitment to do that. So the level of flexibility that you have ultimately is very different. And it means as well that the types of strategies that you might be choosing to embed in a systematic hedge fund strategy will be different because your cost structure is potentially quite different. So lots of significant differences there. It's really in the eye of the beholder and what the beholder is looking for.
In our pre-call, you joked that you were originally hired for skills that are now largely obsolete. But in contrast to that, rough path theory, which is what you spent most of your time working on as a grad student, is suddenly now back fashionable in the machine learning landscape. From your perspective, what do you think is the most exciting frontier where advanced mathematics and modern compute might open up entirely new commodity strategies over the next decade?
Yeah, I mean, I think probably one of the biggest areas and richest hunting grounds in commodities is both the vol space and getting more granular in terms of time structure. So when I say time structure, what I mean is moving from extraday to intraday strategies. And, you know, what's interesting, I think, in particular about the rough path angle is that it allows as well, in combination with the higher frequency of available data, the inclusion of a broader cross-sectional set of assets. And I think this is kind of where there's potentially a lot of really quite interesting relationships which have hitherto really gone probably unnoticed because, quite frankly, you just can't have a human eye at all time scales on all kinds of different things. And as compute power picks up, the ability to parsimoniously summarize dynamic relationships, as is done, for instance, in rough paths, is going to open up a lot of new interesting avenues from a signal generation perspective.
I want to finish off with the same question I've been asking everyone for this season, which is, outside of work, what are you most passionate and excited about today? It could be a new hobby, idea, book, show, music, something related to family. What really has you most excited?
I'm going to give you a very straightforward, time-acute answer here, Corey. It's probably about 95 degrees outside my 245 Park Avenue office. I am super excited on getting on my bus home and going to the pool this evening with my kids. Can't wait for that to happen. But a bit bigger picture, one thing that I have found myself spending an inordinate amount of time on is the various uses of ChatGPT, both in my professional life, but also in my personal life. And the multitude of potential applications just abounds and is something that I find just so extremely exciting.
Well, Ben, thank you so much for taking the time to come chat today. I really appreciate it.
Same. Corey, thanks for having me, and speak soon.